As a Canadian investor, one of my big advantages is being able to spot undervalued Canadian gems. These stocks that present huge upside potential because they are misunderstood by the markets. That means big players, big funds just don't see the value here because they don't really understand the story. Today I'm going to talk about one of those companies, and it's in one of my favorite parts of the Canadian stock market, Canadian oil and gas. And this company is a small cap Canadian giant among retail investors. The investors just love this one. It has been a constant recommendation, and a lot of people think this thing is going places. Welcome to Golden Edge Investing. Today we're going to be talking about Baytex Energy. It's one of those stocks that we've talked about a little bit before on the channel, but that has been absolutely beaten down by the recent crash post-tariffs. Ever since April 2nd, we've seen Canadian and global oil stocks dropping, and small cap stocks are typically the first to get cut and the last to be picked back up. But over the last little while, we've seen the price of oil start to slowly creep up, and we've seen traders turn from very bearish to cautiously bullish. And I think this means there is opportunity for some of us who are willing to take a little bit of risk to pick up smaller cap players that are going to move a little bit later, but that have more time for us to build a position and that might have more potential to be misunderstood because of their relative size. Think about the big players in any market, be it the big tech giants like Meta or Google or Apple or Microsoft, be it the big oil giants. In Canada, we've got CNQ, we've got Suncor, we've got Imperial. They have teams of analysts that cover these stocks day in, day out. They cover these companies. They dive into the earnings. They dive into the actual business, the planning, the operations of all of these companies, and they report it very regularly to the market. You want to go out there and know just about anything about Microsoft's business, you can find that out. And it's a similar story for big Canadian oil producers. You want to know about what's going on at Suncor. You want to know what's going on at Imperial. You want to know what's going on at Enbridge or TC or Pembina. Those companies get talked about. But Baytex only really gets talked about when it's a retail investor, when it's an oil market trader like an Eric Nuttall who goes on and on CNBC or BNN and he talks about these companies. It doesn't get that same kind of attention. And so I think that just maybe a lot of big investors have missed the story of Baytex. And that's really interesting to me because that means that there might be systemic undervaluation here, that we might see a complete re-rating of this company once the story is better told. And stories can take a while to develop, particularly in small cap names in an industry that's on the outs. But imagine the kind of attention that increased investment in Canadian oil and gas could bring. Maybe new pipelines, maybe more projects, maybe more agreements, whatever it might be. As eyes turn to the oil sector, you're going to see companies like this that have a story to tell get a platform to tell it. And you're going to see bigger investors, bigger firms, bigger funds start to take a look and consider, is this worth a little piece of my portfolio? Now, one of the sources that we constantly look to for analysts, for guidance, for real insight into these companies is on Seeking Alpha, because you get a lot of really, really valuable insight from normal retail investors like you and me. And today is no different. We've got an article here from Long Player who talks about oil and gas a lot, and then we've covered a couple of their articles. If you've got Seeking Alpha, I recommend you check them out because they're definitely worth the click. But this article is talking about the importance of the Eagle Ford. And you'll see what they mean, because I think really what this article talks about is how Baytex Energy is not a heavy oil company the way the market's valuing it. And instead, this is a light oil company that the market is just kind of ignoring. Let's go through this article. I'm really interested and I hope you enjoy this. So, summary right there at the top. Baytex Oil has transitioned from a heavy oil operator to a light oil producer with heavy oil exposure. The Eagle Ford acquisition brings lower operating costs and premium oil pricing. The market hasn't fully recognized these changes. Their stock price should rise to better reflect its improved fundamentals. The Eagle Ford has some of the lowest operating costs in North America, and they talk more about this for their private community. I want to point out this was published June 7th. Very updated article. very up to date. They are talking about this now. This is not, a couple months ago. Baytex Energy began as a heavy oil operator, but the acquisition of the Eagle Ford acreage a little while back changed this company to a light oil producer with heavy oil exposure. Yet Mr. Market is still treating the stock as though that heavy oil production emphasis persists. Some of this is due to management choices made during the acquisition to allocate as much as possible to depreciating assets. This protects cash flow, but often gives the impression of break-even operations. Now that those operations are assimilated and lower cost campaigns are being conducted, profitability of that acreage is likely to become apparent to investors. That should result in a higher stock price than is the case now. So essentially what they're saying is that as they bought into this space, as they bought into the Eagle Ford, which is the basin of light oil, of shale oil, as they bought into this basin, they actually kind of went out of their way to make it look like they were just breaking even. They were willing to spend that little money up front because it also gives them advantages when it comes to their actual accounting. Big companies like this go out of their way to make things as cost efficient as possible when it comes to the accounting side, when it comes to the tax side. And that can sometimes distract us as investors because they'll be out there saying, hey, we only made this much money, when the potential to make money was actually much higher, and they chose to only make that much money. Latest Dallas Fed survey. The Dallas Fed periodically repeats its survey on industry costs. Discussion below updates some information covered in the last article and continues the main topic of that article. Operating costs per basin. The Eagle Ford has lower operating costs than the Permian, has a second advantage in that production from the Eagle Ford often receives a premium price for oil, whereas the Permian in the past was faced with capacity issues that caused high transportation costs and sometimes oil price discounts. So you look at this little graph here, we're seeing just like great underperformance or underpricing from that Eagle Ford, right? So everywhere else you see on here is more expensive. Persistence of either or both advantages could well give a company like Baytex a considerable advantage during any cyclical downturn of commodity prices. Have you noticed any cyclical downturns of commodity prices in the oil markets recently? I mean, I'm sure the author is being a little tongue-in-cheek here, but clearly that means now. That means the last 2-3 months, in fact, since the beginning of April, we have seen a downturn in oil prices. And this is not unique to North America, but of course, North America has been hit particularly hard because the tariff wars that everybody is fearing is going to crash the economy, and that, now the story is that we'll see the damage done in Q3 because of the sort of the intricacies of reporting things, and we'll see GDP numbers down and jobless claims up. But still, there's that fear. And of course, fear on its own, without even any damage, still actually causes longer term damages to the markets because fear reduces investment, which in the case of oil reduces increased demand. Investing into new factories, new vehicles, more travel, whatever it might be, from both a consumer and industrial perspective, demands more oil, demands more energy. So every time you see fear in the markets, energy demand is reduced. This is very different, back to the article here. This is very different from the company's original exposure to solely heavy oil prior to the Aurora acquisition in 2014. This acquisition gained some exposure to light oil, but it was made for all debt, which meant the company struggled for some years after the big oil price decline in 2015. Very true. That's actually the story of a lot of these small caps. They made big purchases trying to, continue the peak, the boom times, the early 2010s, and it didn't play out like that. In fact, they saw big price crashes. They saw things get real bad. And of course, there was some sort of artificial price crashing. You see a lot of that same story playing out today with OPEC Plus trying to crash the price of oil, or maybe not crash it, but maybe hold it down a little, increase their production, take market share. And of course, back then they were really trying to kill US shale. Management began to fix the situation with the Raging River acquisition 2018. That acquisition was made for stock. Therefore, the company gained a considerable cash flow edge in 2020 from their increased light oil production. The latest acquisition completed the transition to a light oil producer with heavy oil exposure. Now the company cash flows comparatively generously with the help of those low operating costs shown above, but Mr. Market is clearly not giving credit for the transition because there's a lack of history as the company is composed. Dallas Fed asked about the corporate break-even points for wells. You see the Eagle Ford here is looking at 62, right? 62, 62, 62, 63, 66, 70. So Eagle Ford's still doing pretty good. The question is slightly different from the decision to drill wells, even if the firm loses money. Sometimes a well is profitable enough as opposed to profitable so that the firm gets its money back and has additional cash flow. That makes the well a correct decision during a downturn. The fact that hedges can also be used to delay lower prices is another way in which drilling wells during times of low prices is an acceptable decision. Shown above is the well cost plus an allocation of corporate costs that makes the wells an absolutely profitable decision. Once again, the Eagle Ford is one of the lowest cost basins in the survey. While Baytex Energy management states the Eagle Ford operations lower the corporate cost structure, the investor can tell exactly where management is coming from. Let's talk free cash flow. Company guided to free cash flow, but Baytex acquired Ranger Oil in June of 2023. That likely means that the assimilation process has completed to the point where average costs should decline in the future for some time to come. If one assumes that newer production will be lower cost than acquired production because the company has cost reduction goals every year in these presentations, for as long as the author can remember, then that free cash flow should rise over time at each pricing level. That may be important during a period of pricing weakness when service costs are also likely to decline. It is also likely that the one-time costs associated with the merger have largely completed, and any conservative depreciation choices associated with the merger are declining in importance as well. Therefore, profitability is likely to increase going forwards at various pricing points. There's a very good chance from the latest stock price action that Mr. Market is not expecting any upside potential. And that's very true. When you saw the COVID and you know that kind of crash, you saw Baytex recover from there. When you saw that 2020 era, okay, then into that 2022 when prices shot up, Baytex recovered, and it was clear that, you know, as the crisis became less apparent, Baytex was given the benefit of the doubt. And that hasn't happened so much here. Baytex has absolutely been a slow mover. And you know what? Over the last week or so, they've started to catch up a little bit to their peers. But they've got a long way to go. If you compare them to a lot of the bigger companies, again, those bigger companies have whole teams of analysts covering them and that are letting their big market money managers, you know, the big banks here in Canada, the big funds down in the US, be it hedge funds, index funds, whatever it might be, pension funds. They've been letting those managers know, hey, these guys have this going for them. They have this going for them. These are their cost structures. These are the advantages. They cash flow this much money. They're increasing their dividends. They're increasing share repurchases. And the price of oil actually doesn't look that bad. Baytex doesn't have any of that. So it's just been kind of sitting there, ignored. And yeah, it's got its core shareholder base, but the core shareholder base, or even usually in small stocks like this, unless you get a big group of retail, they don't get moved by that. They get moved when you see bigger money managers step in. Or in the case of someone like Meg, when you get an acquisition, you know, all of a sudden somebody offers to take you private and you see what they're willing to value you at, all of a sudden the market has to move. And again, it's the big money managers that move the market. When it's being ignored like this by Mr. Market, which just means sort of the general apparatus of big money, there's opportunity for us as the little fish here in this big ocean. There's opportunity for us to maybe step in. Similarly, this is the first downturn the company will go through with a reasonable projected debt. The Raging River acquisition was made with stock and lowered the debt ratio materially before the 2020 challenges. But this acquisition is really the first time that the debt ratio is satisfactory to a market immediately after an acquisition. This again is something with no track record. The market often demands a track record before the stock price reacts accordingly. Nobody's willing to bet on something that has never happened before. I mean, okay, I shouldn't say never. But in a commodity-driven market like this, if you can't prove that something you own is valuable, market's not going to give you the benefit of the doubt. You got to prove it to us. Show me the money. That's the phrase, right? If you can't show me the money, I'm not giving you my investment dollars. Well, again, as retail, we have the opportunity to take slight risks that maybe these big fund managers on their short time frames, I should say, just can't. Lease profitability. Shown below is the different basins where the company has leases and their assumed profitability at WTI 75. Eagle Ford wells can have some very low break-even points due to the low operating costs shown above. Like anything else, the acreage results can vary though. So it's important for management to have had the previous roughly 2 years to get a handle on the situation. It is very likely that the wells drilled in the future will be more profitable than in the past. The operator of the Aurora acreage was Marathon Oil, which was recently acquired by ConocoPhillips. Since Marathon was a well-known top-tier operator, it is very likely the information gained by Baytex through the partnership with Marathon helped to speed up the cost-lowering process of the last 2 years. Summary. Baytex Energy is entering the current cyclical downturn with material advantage that it did not have in the past in the form of much more Eagle Ford production that it operates. This low-cost acreage may outperform market expectations as shown by the price of the stock. And look, they show you, look at the stock price decline, right? Maybe a year ago, we were trading at not quite triple, but double, at least double. And then it's just been down and down and down. This is maybe those fears over, Canada-specific tariffs. Then it sat here, then, more fears about Canada-specific tariffs into February. Then, of course, you can see April. And then we've just been slowly trying to catch up. And again, over the last week, since this article was published, you've seen a little bit more action, but not much. And definitely not enough to get you back to where we started the year, down 50% over a 1-year basis. So I would expect to see a lot of that pulled back over the next couple of months. Stock price action is likely caused by analyst estimates as summarized below by the website, right? So if you look at Seeking Alpha's estimates, they're not giving really good ones. It's very likely the earnings will benefit both from the lower cost Clearwater development as well as the increasing efficiencies in the Eagle Ford. Maybe a bit hard for the market to tell that, but at least some of those analyst earnings estimates could prove to be conservative. Additionally, the company has a whole year to improve that fiscal year 2026 estimate. All that means that Baytex Energy is still likely a strong buy consideration. There are always going to be immediate costs associated with the acquisition, but the market often assumes these costs go on forever, even though the industry generally has a goal of lowering costs every year. Now, there could be some effect from the steel tariffs that are currently being negotiated. I personally believe the current threats are negotiating tactics that will be replaced by something that is more constructive and permanent. Since this article came out, that did not come true. Sorry to the author, but yeah, the steel tariffs definitely did happen. We'll see. Lots of the steel problems for operators like this that operate in the United States is just that, you need so much of it, and so much of it comes from the rest of the world, right? No knock on the US steel market, but as a Canadian, I think we have a lot to offer, and we offer it at a pretty good price. And it's actually, pretty cheap to make steel here in contrast because of a variety of factors. And, we're Canadians. We're not some foreign enemy. We're your buddies next door. And it'd be nice if you took our products and didn't tariff us for it. Maybe, we'd come up with a deal to tariff everyone else together, but it'd be nice if we were on the same team, but not my place. Right? And that's not sort of a market that I really understand well. And maybe there are arguments, but I don't know. Obviously, Canadian, super biased. But I think there's huge potential in Baytex. I think that despite all of the challenges, despite the tariffs, the dropping price of oil, despite all of that, there is huge opportunity for them to outperform because the bar is on the floor. Seriously, stock's down 50% over a year. They have had so much negative sentiment. Everybody is selling out, including big guys who run these funds, who have been talking them up, who've been talking about the potential of the share repurchases. But the thing is, all of those big players are beholden to short-term shareholder interest. And you aren't. If you're watching this video, you're likely a retail shareholder. The short term is not what matters to you. What you care about is the opportunity to outperform the market, because otherwise, why are we doing this? If we're not trying to outperform, even with that small, satellite position in our portfolio, if we're not using that to try to beat the market, we should just own an index fund and be, have a different hobby, right? We should be talking about golfing or, another sport, right? We should be talking about the hockey games going on. We shouldn't be focused on stocks like this. But if we are trying to outperform, then it makes a lot of sense that when you see a stock like this that is being valued like a Canadian heavy oil producer, like a small cap company with lots of debt that's selling a product that is sort of discounted, selling at a WCS price, barely making cash flow. But instead, this company also owns a significant amount of really high quality US light oil. that sells at a great price at a time when WTI oil prices are dramatically outperforming expectations, at a time when OPEC looks like it has a louder bark than it has a hard bite, at a time when Canadian oil and gas is suddenly attracting a lot of attention from big investors, and there has been a whole slew of mergers and acquisitions. Are you telling me that this company has no upside potential, really? That we should price in no potential for outperformance? I don't believe that. And I think the fact that big money managers are holding this price down, have allowed it to drop so far, means that we have the opportunity to double our money. It's not unreasonable to see this stock back up to the price it was at a year ago. That's a doubling of money. Beyond that, we have seen the kind of returns this company talked about just 2-3 months ago. They were talking about returning up to 60% of their current market cap to shareholders over the next couple of years through stock repurchases, through dividends. There is no reason they couldn't still do that, especially if we see the oil price start to go up. So, do I think this one's worth a flyer? Yeah, maybe. I think you need to take a look at this, make sure it fits your portfolio, make sure it's, it makes sense to you, make sure you're allocating an amount of money that is reasonable. But I think it's worth a flyer, and I think it's worth looking at stocks like this. There's definitely room for a larger conversation here about the opportunity in smaller cap Canadian stocks. Because seriously, some of these are the most undervalued stocks I've seen in the market anywhere. They're trading at crazy price to free cash flow, crazy price to earnings. Their enterprise value is dramatically lower than it should be. Like, there are companies out there that are being valued at less than the sum of their parts. And if they're a solidly managed, good free cash flowing business that returns value to shareholders that you are getting paid to hold, there's just about no argument not to hold them. So those are my thoughts on Baytex Energy. I think it is definitely misunderstood. And I think if you're the kind of person who's looking for maybe not your whole portfolio, actually, definitely not your whole portfolio, but just a chunk, a couple percentage here or there. You're looking for that extra boost to get you to outperform in 2025, in 2026. I think this stock could be one of those stocks that surprises. And if you're looking for a small cap Canadian oil and gas player that has a lot of exposure to really high quality light oil production that is selling at a premium, Baytex Energy might just be your stock. That's about all I have for you folks today. Let me know what you thought of that video. Again, this is one of those videos that's been requested many, many times on the channel. And I just, I love when you guys request stocks like this. So please let me know in the comments down below. What other stocks do you think are out there that are, smaller cap Canadian stocks that are misunderstood? And alternatively, are there other big Canadian companies that you think are just being completely undervalued by the markets? I would love to hear your opinions in the comments. Let me know, and I will definitely look into them. And with all that being said, I hope you enjoyed the video, and I'll see you in the next one.